folks, it's Dave Burrows. It is Tuesday afternoon, and I want to welcome you to a Barometer Reading webcast. Um, been a busy week. Good to see that Thanksgiving week has started off in a friendly way. Very often we get stronger markets into the week of Thanksgiving. Brent has been sloppy really since the end of September, narrowing in bits and pieces. So there's been some good pockets of strength, and there have been some areas that we've had to avoid. We have a little bit of cash in the portfolios, and the question will be, was the reversal at the end of last week an important reversal? Can we get some follow through? These are things that we're thinking about, and we can talk about today. So just off the top, as we always do, S&P has been working its way higher since early 2013. We've been in a structural bull market, and these tend to go on a long time. I think that we have three basic jobs in what we do. One is to try and identify the key structural themes that are in place in the market, types of assets that are being revalued, where money is being brought to bear and multiples are expanding due to some structural change in the economy, and focus our attention in those areas. That might be specific sectors or themes or geographic regions or asset classes. But structural revaluations tend to go on a while, and they have interruptions. But the goal is to get there and stay there, and take advantage of those reevaluations, to recognize change in leadership as it starts to emerge, and old leadership as it starts to lose ground. And that's obviously an important factor. And then there are some times when it's better to sit on your hands and let some traffic pass, because we're not getting paid to be invested. Our job is to make money. And sometimes it's easier, sometimes it's harder, but there are times to be pushing on the gas and there's time to be tapping on the brake. So when we look at this bull market that we've been in since 2013, these are monthly bars. You can see we've been working our way higher. We had this interruption in the spring on the Trump tariffs, where the S&P traded down toward the 200-week moving average and very quickly reversed. We've been marching higher since. You can see in the month of November, market's down just a little bit. If we look at it under the microscope, this is the S&P 500. Over the last few weeks, we traded down, tested the 50-day and traded down through it. Today, the S&P is working its way at getting back through the 50-day. Probably the bigger culprit in the discussion has been the NASDAQ 100 and large cap tech. And the question is it overvalued? Are there risks to the boom in AI spending? And more importantly, the valuations of the companies involved in it. You can see we did trade down below the 200. We tried to start below the 50-day. We tried to rally back up into the channel last week, which was rejected. A big outside reversal day on the day that NVIDIA reported their earnings. And then we had Friday, Monday, and Tuesday. So as we close today, I believe just below the 50-day moving average. It's been an interesting couple of days. So as always, we have to look at it through the lens that we look through. Our job is to understand the big picture, the top down, of all of the groups we can focus in, which ones are seeing net inflows of capital. And we want to focus our attention in those areas. And at any given time, there could be a few sectors or themes that are driving returns, or there could be lots. Obviously, when there's lots, it's a healthier market. When there's fewer sources of strength, that's one that we have to be concerned about. And certainly, if it's just a few and that number is contracting, that's something that we care about. But we're always looking for parts of the market where we can see over time more and more securities participating in a rally. That's a healthy market. That's money being brought to bear. Now, once we identify neighborhoods we want to focus in, we got to find securities to populate the portfolios with. And our belief has always been we buy companies that are good getting better. Why is that? Well, first of all, you're not dependent on something improving in the future for the company to remain solvent. So we are not turnaround specialists. We want to find something that is solid from an income statement and a balance sheet perspective to begin with, that meets a combination of about 20 business factors that point to acceleration in the business model, and prices that are doing what they should be doing given what we think we know. The reason we want to look for acceleration of the second derivative and improvement in the financial metrics is because the market often has to play catch up as they recognize something changes and they are prepared to pay a higher and higher multiple as those changes take place. So we can find securities that are good getting better that meet those tests in parts of the market that are seeing net inflows of capital. Well, that's where our portfolio should live. And then importantly, when we see periods of time where at the asset class level or the geographic level or the sector or the theme, we start to see deterioration where fewer and fewer stocks are performing well. Well, that tells us we got to be a little more cautious. Now, you don't know whether that's a short-term issue, and there's lots of those, or whether it's a longer-term issue. But big corrections start with small corrections. And so we always err on the side of being more cautious to say, if breadth is deteriorating, we stop putting on new positions. We raise a bit of cash. And to the extent we get stopped out against our stop losses, the cash position builds because we stop putting on new positions. But a correction is a really valuable point in time because it gives us the opportunity to see what is it that despite all the bad news isn't going down. Where is there very high conviction on behalf of investors? No willingness to sell. So at a time when breadth is narrow, as it has been, our job is to make sure, first of all, that the positions we own continue to meet all of our tests, stay above our stop loss levels. And then we're busy building a farm team. It's one of our favorite times when you go through a market that's sloppy, because that testing is like a sorting hat. The solid boulders are unmoved, and the stuff that's lightweight gets blown away. So over the last couple of months, we've seen some deterioration in breadth. First, we saw some weakness in the U.S. market. The percent of U.S. stocks in trends has been deteriorating. Now, it doesn't mean they all have, but it does mean that the market is testing resolve of investors. Then we saw some weakness in global breadth outside the US and in Canada. Although breadth in Canada has actually stayed pretty firm. We'll talk about that. If we look at the percent of stocks trading above the 50-day moving average, which is a really great short-term measure of trend strength. And interestingly, yesterday, the percent of stocks trading above the 50-day moving average in the US showed some improvement. That's one of 4 short-term indicators. So interesting, not enough to make us put money to work. When we look at the percent of stocks with positive weekly momentum or upward trajectory, that's been weakening fairly steadily. Percent of stocks making new highs versus new lows, and we talk about that. Lots of stocks making new lows, very few stocks making new highs. That's something that we watch. And then the longer term measure, what percent of stocks are trading above the 150-week or long-term moving average? So we looked at all these things this morning. Now we'll look at them again tomorrow. But given the very strong day that the market had yesterday, these all moved up by a fraction of 1%. It takes a 6% reversal to change direction. So we'll see. But breadth in the NYSE has been weakening. Breadth in the NASDAQ has been weakening, with only now about 32% of stocks trading in an uptrend, and the percent of stocks in the NASDAQ 100 trading closer to 30%. It may be that we will see a reversal higher in small caps today. That's something that we'll watch. Now, last week, we looked at the fact that we saw the NASDAQ 100 break to a lower low, which then traded lower from there. Today, rallied up and filled this cup. and the same for the Russell 2000. So technically, there's some damage out there. Can it get repaired? Of course it can. But when we're in lower lows and lower highs, we're a little more cautious. Now, looking outside the US, it's interesting. There's been a little bit of a pullback. Developed world ex US, so developed markets around the world, ex US stocks, down 0.84% in the month of November. So not very much. If we look at the Eurozone's down 0.72 of 1%. I threw on this chart the point and figure chart, higher high, higher low, higher high, has not pulled back into a column of zeros, let alone broken the previous low. Technically, looks fine. Eurostoxx 50 relative performance versus the equally weighted S&P 500 continues to make a turn. So one of the things we're noting is that while nothing is immune when the market pulls back, we care about what is relatively stronger. And so far, international stocks relatively stronger. Japanese stocks have pulled back a little, but look, we're just in the very early stages of a new bull market. So on one hand, some of the economic data is weak. On the other hand, Japanese policymakers are looking at rolling out additional fiscal stimulus, which is a cause for concern for Japanese bonds. But this is what pushes people into stocks. Emerging markets has been pressing up against the top of its range going back to 2007, unable yet to get out. But we have seen a nice pickup in relative momentum over the last few weeks. And if we look at the all-world ex-US index versus an equally weighted S&P, it broke out in the month of October and continues higher in the month of November. So the question is, that's begun. Can it go on for long? Just to put it in context. Before Japan went into its bear market, Japan made up about 45% of the total value of the world's stock markets. Today, that's a little over 5%. Europe at its peak, going back to around 2000, is 35% of the world's stock market value. Today, around 15%. And the US, back when Japan was the all-powerful market, was 30% of the total value of this world stock market. It's 75% today. So when this rotation takes place, it doesn't mean it's going all the way back, but it does mean that there's room for it to go higher. Now, the TSX in our local market has been remarkably strong. These are monthly bars. So going back to last summer, 1, 2, 3, 4, 5, 6, 7 months straight higher. This month up 2.14%. And the point and figure chart, after running up into this consolidation zone, is marching higher, broke a double top at 1800, broke a triple top at 1810, and today closed at new highs. So that's a daily chart. It's worth watching. Canadian market has been immune to this weakness. And the TSX relative to the equal weight S&P has now been sprinting higher relative to the US market all year long, despite concerns about tariffs and economic weakness. Has more to do with what's going on in some of our big companies that are more global in nature and in industries that are benefiting in the current world. Banks, low short-term rates, higher long-term rates, an opportunity to make a margin, and demand for loan growth. Now, when we look at Europe, is it as innovative as the US stock market? No, there's not a lot of technology. But we can see that the PMI data is improving nicely. And GDP, ex-Ireland, getting better. So our focus in global stocks or international stocks has been working out well since we launched the global fund in December of 23. Now up 56.6%. The index is up 42.9 for the all world index. So just about 14% ahead over 2 years. We had hoped to get 5% excess return per year. It's working out to be a little better than that. and certainly a lot better than what's happening in the equally weighted S&P. Moving on to fixed income, bond yields continue to be sticky high in the long end, and Japan's bond yields are not helping. Japanese 30-year bond yields since July of 2019 have now gone from basically zero to 3.33%. And for a Japanese bond investor who has to hedge currency risk back to Japan if they own US Treasury bonds, can now make more in their local market. This is something worth watching because the Japanese have $1.3 trillion worth of US dollar assets. So the bond market continues to be a place for kind of avoiding lower lows and lower highs in the long end of the US bond market. And you can see the point and figure chart broke and has been working its way lower. We think the bonds continue in a bear market. So that tells us inflation is probably still an issue. Long-term bond investors demanding a yield to compensate them for the risk that their purchasing power when they get the money back someday in the future will be much lower. On the other hand, we continue to see strength in commodity prices. Now, a few weeks ago, we said we thought gold maybe was set up for a correction. It's been about 8 weeks. Really hasn't corrected very much, to be honest with you. I'm surprised. We did see record outflows a couple of weeks ago. That's people taking profit. It may well be that the central banks are standing in as the buyer, and that's why we haven't seen much weakness. The truth is, though, I think we're still in the early days of a gold bull market. Now, in previous bull markets, you did have a corrective period after the first run up. We'll see whether this turns into something more. But central banks just continue to be buyers. In the month of September, the Chinese bought something like 3 times their monthly average. And we saw central banks reporting 39 tons of net purchases. And we're not sure that we're actually capturing all the data. Some of it might be happening in dark pools. Copper continues to be resilient, it's trading right at the top of the range. So commodities relative to bonds are in a clear uptrend above all the moving average, and commodities versus stocks are in an uptrend. So this tells us this is an important diversifier in portfolios. Despite the fact we all fear the word cyclical, and they are cyclical, they can move around. Again, this is an asset that's been remarkably resilient as we've gone through a little bit of a correction. I think it's interesting when we look at the US dollar, because the US dollar rallied over a decade into 2022, where it made a high. It chopped around and made a lower high in 2025, and then broke all of this support in the early part of this year in May, June. Now, over the last 5 or 6 months, it's rallied back up underneath the point it broke down. But in the month of November, it's now backing off of that resistance point. That could be interesting. This could have been the cause of the correction in gold. If we were to see the US dollar back off, and technically you would expect to target somewhere around 90, that would be a real positive for global stocks if the US dollar backed off, and it would be a real positive for commodities. So worth watching, and we'll watch to see if we can get below the low from the month of October. But the longer term trend is down. I think it confirms this look, gold versus tech, which turned up in 2000 and didn't turn back down on a relative basis till 2011. Gold went through a bottoming period and again, clearly is in a relative uptrend versus tech. That would be a significant change. And that's one of the reasons that we're more cautious on technology. So let's look at the sector work, because I think it's important. We want to see how things are hanging in. The financial sector in the US, the broad-based financial sector we talked about last week, there are some parts of it that have been weak. Insurance have been weak. Regional banks have been weak, although they had a pretty good day today. The payments companies like Visa and PayPal and Fiserv have been weak. Private equity's been weak. But the banks have been pretty darn strong. This is the equally weighted basket of the major Canadian banks. Look at the relative strength marching higher. And today, that equally weighted basket went out at a new high. So led by companies like National Bank, Royal Bank, um, and then below the banks, the financials holding companies like Power Corp. Look at Power Corp, the way it's been powering higher. So why do we like Power Corp? Great cash flow growth, great shareholder-friendly policies of returning capital to shareholders through share buybacks and dividend increases, and a 3.5% dividend yield that's growing darn close to 10%. In the US, JP Morgan continues to hang in quite nicely. Relative strength has been in an uptrend. It is below the 50-day moving average, but is in higher highs and higher lows. Morgan Stanley, same thing, back above the 50-day moving average, probably acting a little better than JP Morgan. Those are our two big US weights. And Eurozone financials actually really haven't skipped a beat. I think it's an important point to make that in the banking sector, an index of the world's banks is just breaking out to new highs for the first time since 2008. And over 90% of them are trading above the 200-day moving average. Loan growth around the world is growing. So I've said over the last couple of years, in a world where long-term interest rates are going higher, the power belongs in the hands of the lender. We want to own companies with pricing power, and the banks have pricing power for the first time in a long time. So outside the US, we're seeing strength in banks as well. And in some cases, more strength than we're seeing in the US. And Santander continues to be one of those companies. Higher highs and higher lows. There is nothing that moves straight higher without pulling back to the moving averages. This has done exactly that. It's flipping back higher. Great day today up 3%. So financials continue to be our most important theme in portfolios. Now, hand in glove, industrials have been important strength and important positions in the portfolio. We did see over the last few weeks, it dipped below the 50-day moving average. And that's in part because of the weakness in transports. Transports have been unable to make a new high. That's something that we're watching closely. Probably has to do with what's going on in friction in trade. But in aerospace, it continues to perform pretty well. Howmet Aerospace, which of course makes fan blades for jet engines, have been a strong performer both on the defense side and the commercial airjet side. Been a holding for a couple of years. Bombardier, a relatively new holding for us, made a new absolute and relative high today, moving sharply higher over the last week. The business jet market is very strong. Raytheon continues to stay above the 50-day moving average and move higher on a relative basis. And then the heavy equipment companies selling into both mining and data center power generation, Caterpillar and Finning, both continuing to act really well. Great test of leadership, and these are passing with flying colors. Toromont also fits the bill, also a Caterpillar dealer here in Canada. So the heavy equipment folks continue to behave pretty well. Moving on to energy, we highlighted last week that the XEG, which is the Canadian oil and gas ETF, made a new high, and we stayed there over the course of the week. If you look at the daily chart, we pulled back 3 or 4 days above the range, but we were highlighting the fact it's interesting that the shares of the big Canadian oil companies are way outperforming what's happening in the price of oil. And this week, oil was down $56, $57 a barrel, and the oil companies remain pretty firm. We think that we're in the very early stages of what could be a longer-term bull market in energy. And it's important to know that energy has been a big part of the S&P in the past, even though it's only a 2% weight today. This actually speaks to an important point that we've been thinking about, and that is, how do you get exposure to a neighborhood when at the beginning of a bull market, some of the sectors that might become big parts of the index later on are so small to begin with that they really don't mean much. If you buy the S&P today, energy is 2% of the index. If it happens to be part of the strength in the index, and if it happens to be that technology takes a back seat for a while, with over 35% of the index in technology and 2% in energy, that can be difficult. So we do think that we're into a market where active management is important, and also looking for neighborhoods, geographic regions where energy is a bigger part. Certainly in Canada, we're benefiting. We've got some very big, long life asset companies with a lot of assets under the ground, like Imperial Oil, that are efficient producers, generating lots of cash and showing a real willingness to return it to shareholder. In the meantime, we're getting paid a 2% plus dividend that's been growing over 25% a year. So, stock's been rallying nicely. We think it can go on for a long time. It continues to be very resilient. So is Tamarack Valley, so is Suncor. This is a group, I think, that is hanging in really well against what has been a little bit sloppier market. On the gold front, as I mentioned, 8 weeks of correction. You see the point and figure chart broke down, made lower highs and lower lows, and now it's trying to reverse. We'll see. It may well be that it's ready. We did put a couple of positions back on. We put on some Kinross. We put on some Agnico Eagle. They're trying to firm up. If they're able to stay this way, maybe we add some more. Look at relative strength continues to improve. My guess is there's a little bit more sideways to come, but this is one of the strongest parts of the market. Copper producers also very resilient. This is a long-term chart, and this moved down in the month of October, came down and closed a gap on the chart and right back up into the consolidation range. You'll see that Hudbay dropped briefly below a 50-day moving average, continues to hang up. Nice, strong relative strength. So it's important for leading stocks to get tested from time to time by the market, because we want to understand, are there buyers under the surface? And I think this is an important tell. Now let's talk about consumer discretionary for a minute. It continues to be sloppy. Had a better day today, but many of the parts of consumer discretionary continue to be restaurants, retailers, home builders. Although home builders had a good day today, the charts are still technically broken. Let's talk about technology for a minute. Technology came down over this rising wedge. It has been correcting over the last few weeks. You can see relative strength uptrend was broken. Still trading better than the 82% of companies in the S&P over the 52 weeks, but certainly you're seeing a test in some of the bigger names. If we look at the small cap growth-oriented technology companies, they corrected more, 23-24% top to bottom. They bounced over the last 3 days. That really doesn't fix the technical picture. You can see the point and figure charts after coming to a very narrow range. This wedge pattern broke down, made a lower high, lower low, lower high, and at this point we'll see whether this can get fixed. We're testing the 200-day moving average. On software, it's the same picture. We're down at the 200-day moving average. It's been about a 13% correction, top to bottom. And the point and figure chart, again, broke down. Right now, we're up filling this cup, which, again, does not fix the picture. There's no work to do here. And on semiconductors, which is probably the most important group for technology, you can see, again, point and figure chart broke down. We've rallied up underneath the breakdown point, but below the 50-day moving average. So we've got to watch this group closely. Now, how are our positions hanging in? Well, our 3 biggest positions, I think, are hanging in pretty well. Broadcom obviously making great strides versus the sector with their TPUs and some of the news coming out on new contracts, trading better than 95% of companies in the S&P and not a blip in relative price performance. Alphabet is appearing to be one of the winners in AI. What correction in AI? Congratulations to James, who's done a great job putting us in this position, trading better than 96% of companies in the S&P. And NVIDIA is probably the biggest question mark that we have. We're now trading below the 50-day moving average. There's no question it is the behemoth in the industry. They reported great earnings. Its stock rallied on the day and then failed and closed lower than the day before. We're trading above a rising 200-week moving average, and relative strength has been good, but you can see it's waning. So look, a lot is going to rest on the next couple of days here. We are in this whole consolidation range that has been in since July. We're going to have to make a call on that. And we're getting darn close to our stops. But overall, I think the positions we have in tech have been hanging in pretty well. As I mentioned, consumer discretionary sloppy, communication services sloppy. Let's try and sum it up. On the 23rd of September, we took all the sectors and put them on a distribution curve. We plotted the ones with rising breadth in capital letters and weakening breadth in small letters. The average sector had 51.6% of stocks in uptrends, a fairly even sector distribution. On the 20th of October, a few more in small letters, meaning breadth breaking down. The average sector at 48% of stocks in uptrends. On the 3rd of November, 45% of stocks in uptrends, and very few sectors in capital letters. And as we sit here today, last week, the average sector with 39% of stocks in uptrends, and as of today, the average sector with 37% of stocks in uptrends, and skewed to the left. Now, on the right, we've got a bunch of financial stuff, energy, precious metals. That's fine. And on the left, software, semiconductors, leisure, restaurants, housing, retail, technology, some of the groups we've been talking about. So we'll watch for these to turn higher. One thing I will note is we've seen recent strength in healthcare. We have a little bit of biotech exposure, but that's a group that's standing out during this correction. We'll have to see how they do when they start to make a turn. Certainly, we're building some quarantine numbers there. So overall, what does it look like? Financials continue to be our biggest weight. Pretty significant overweight versus the S&P. We've got that solid cash position we talked about last week that gives us flexibility. Industrials are about 15%, almost twice what the index is. Materials are very significant overweight. And frankly, that's probably our best inflation hedge. Technology about 9%, about a third of the index weight. Energy sitting at just about 9%, just about twice the weight of the S&P. But pretty much everything else is an underweight. Google, of course, fits in communication services, so that's our big position here. Healthcare is an underweight, consumers an underweight, utilities an underweight, staples an underweight, and real estate an underweight. So that's what you would call an actively weighted portfolio. It's very little like the index, and we're managing each position day by day. From a strategy perspective, with the equal weight S&P and Canadian dollars up 5.8% on the year, the aggregate bond index up 4%. Our equity portfolio is up 19.58. Our income portfolio is up 10.57. You know what? I've got the date wrong here. I apologize. These are all 2-3% lower, but hanging in remarkably well versus the index. Somehow I put the wrong chart up there. I apologize. I'll fix that for next week. Things that we're watching. We're watching credit default swaps. We're watching the risk premium that bond investors are demanding on investment grade and high yield bonds. It's widened a very little bit. But frankly, nothing compared to any of the significant corrections we've had going back to 2009. So I would say at this point, nothing to see in the world of corporate bonds. I will say high yield bonds are now relatively underperforming investment grade, and that makes sense, but not by much. From a volatility perspective, volatility spiked last week, but we're right back down into the center of the range. So that's a positive. From a long-term perspective, this little bit of weakness over the last couple of weeks doesn't really even show on the chart. Now we're very, very careful. We understand the most important job we have is not to lose money. So I like the fact that we've got some cash, but I have to say, when we go through our current positions, we're very, very happy with the way they're hanging in. Now, maybe it is that in the week of Thanksgiving, we're going to get things swung around. I know that exposures and hedge funds have come down substantially. There are quite large short positions in the market. Those could be a support. And frankly, earnings estimates aren't getting worse, they're getting better. If things get worse, we'll wind up raising a little bit more cash. But we like the position we're in heading into the holiday season. With that, let's see if there's some questions I can answer. Okay, what do we got? Robert Marr is that is what NBO. I have to be honest, Robert, I haven't taken a close look at NBO recently, so I got to take a closer look. And I'll come back to you on that. Lauren, seems to me there's been some sector rotation with healthcare, one of the rising sectors. My thoughts. Yeah, for sure. Over the last few weeks, healthcare has been performing better. Lilly, in particular, on the pharmaceutical side. See if I can share a couple of charts here. Okay, let's see if we can share. Okay, so let's just start with Lilly. I think you can see this. Look at the move here in gold. So this is something that's very interesting. The fact this is happening in a sloppy take now. Clearly, healthcare is a defensive sector. Tends to be a sector that people go to when they are trying to hide from something that's correcting. But there is news happening in the weight loss drugs. Obviously, the Trump administration is working at making these drugs more affordable because they can help head off at the path some of the most important diseases in the U.S. So that's something to watch. The biotech stocks, made a really nice turn here. So you had pretty classic bottoming process, a series of lows, one in 22, one in 23, one in 25. We've taken out these recent highs since the last 6 weeks. Again, that's pretty interesting. If you look at a longer term picture, that may be setting up. We don't know whether if the market starts to firm up and people get a little bit more less cautious, if maybe healthcare doesn't back off. Typically, you would expect it to, but certainly worth watching. Devices have been so-so. Healthcare providers not so great, but certainly biotech and pharma looking better, and we definitely have some fun key names in the area. Oh, there we go. Todd Beister asked the same question. What are our views on AI-related trade? Do we still own Celestica and Lam Research? And the answer is yes on the Celestica. What a dynamite stock. Pulled right back to the 50-day moving average, after a great run up and held very, very nicely and is marching higher. So, we continue to be there. Where we suggest putting cash right now, short-term bonds. Frankly, I had a slide in the deck just showing how cash value gets devalued over time. We are not with this cash planning on staying in cash for long. My guess is it would be a relatively short period of time. I don't think that this secular bull market's over. I think that we're just correcting. So my guess is we'll probably put it back in pretty quickly. We would just frankly use T-bills and money market instruments in the very short run. Third question about healthcare. So I'll just go back and say this. If a group of stocks is firming up in a sloppy take, we care. It may be that it's just a defensive trade. Portfolio managers who have to be in the market, moving money into a sector that's less economically sensitive. So sometimes seeing defensive stocks rally when the tape gets sloppy doesn't tell you that they're going to lead on the other side. But it certainly tells us that we need to build a farm team of companies that we would like to own if our Brent data gets swung around. So the jury is out, but certainly, we're building a farm team, and I would say probability is at the top of the list. Let's see. Oh, thoughts on C limited. Well, picture tells 1,000 words. So C limited performed really well while communication stocks are performing well. Um, to the west, this is kind of a kiss of death. First line in the sand, you don't like to see it cross at the 50-day. Of course, then crossing the 200-day. If I were to pull it up on a point and finger price chart, that's a pretty clear signal. So as you know, this was a position for us. We got stopped out of it, and that's why we start use stop losses. Look at this series of lower lows and lower highs. So a value investor might be more willing to step in on something like that. It's not going to be us. Is it safe to say U.S.-China tariff pause agreed? The Senate earlier this month puts a hard floor under Apple and Tesla. I'm not sure we can say that. Um, certainly Apple's behaving better, and strong stock in the consumer sector. On the Tesla, I like the long-term setup on Tesla. In the near term, trading below the 50-day with a bunch of resistance above, I probably would give it a little bit of time to work out. Um, Frankly, I probably would wait and buy it above 475 as it breaks out. Um, I think there's a lot of factors going on there. Tesla has lots of things going right, and the humanoid robots, I think, are likely to be a big driver. Self-driving taxis is going to be a big driver, um, but technically in the short run, just not there. Do you have an opinion on index-related financial? Understand BlackRock? Yeah, they're just not behaving very well. Um, if you look at BlackRock, hard break below the 200-day moving average. It's not great. If we look at the point and finger chart, pretty hard break from trend. I think probably it needs some work. You know, some of the private equity companies also looking pretty sloppy. That's Blackstone. The exchange, the index companies, MSCI, really not much to point to here. Indecision on the point and figure chart. This is 2024. This is 2025. Relative strength is weak. I think I would wait. Okay, I think we got most of the questions. Thanks everybody for joining this week. We'll get more information as time goes by. This may turn into being just a short-term correction, or may turn into something longer. I think you have to have a balanced approach. We want to make sure that everything we're holding right now is technically sound. You want to be building a farm team of things you'd like to own, if things are going to start to improve. And don't be a rush. You got lots of time. Thanks, folks, for joining in. We'll see you again next week.